Okay, in Chapter 4, we're going to continue on with our exploration of consolidations by adding in the next issue, which is intercompany transactions. The parent and the sub are reporting as a single economic unit, and as such, they have to consider the fact that when they're doing business between the parent and the sub, that it's not a reportable event from a GAAP standpoint because it didn't happen with an outside party and therefore it has to be eliminated. So again, using the chart on the inside of your text cover, you'll see that there's a number of identification things that these authors use to identify those entries, and we're going to focus right now on the ones related specifically to inventory, the BI, EI, and IS. We're going to focus on those three. So using the example exercise 4.1 from your textbook, you'll see that up above here I have the revenue and income statement information for the parent and the sub. It also tells us in the text for that exercise that 120 of the sales made by the subsidiary were actually intercompany sales. Those sales then cannot be recognized as part of the consolidated financial statements, so we need to take them out because those represent something that was purely an internal transfer. So we're going to take them out of sales and out of cost of goods sold because that intercompany piece also affected cost of goods sold when the parent sold them. So we're going to simply reverse those out. Has no impact to total net income, but it does reduce total sales and cost of goods sold, which we know can appearance of financial reporting in terms of decision making for total sales, total gross profit, etc. So it is important that we consider that elimination. The other factor then is if any of those goods are in beginning or ending inventory. In this example they said that 2011 was the first year, so there's no beginning inventory, but we do have ending inventory, and it tells us in ending inventory there were 30,000 of the goods still in inventory. Well, a portion of that 30,000 is the cost that it actually cost even the sub to purchase it from an external party. So we only want to eliminate the internal profit factor that hasn't yet been earned because there hasn't been an outside party transaction. So we're going to eliminate the gross profit on those intercompany sales. See, the gross profit was calculated up above the way we've always done gross profit. It's gross profit divided by sales. So we're going to eliminate 12,000 in the current year from the ending inventory, so ending inventory is not overstated, and we're going to adjust it through cost of goods sold, and we'll see how that offsets in the next year here in a second when we get to 2012. So this is only a partial example, but these would be your worksheet entries, and as the worksheet lines came across, we would be calculating our consolidated income statement, which is what we're going to do down below. So just like on the worksheet, as the amounts come across for the parent and the sub, we also consider any of the worksheet entry impact. So here we're going to eliminate those intercompany sales so that our total sales reported is 630. We're going to do the same thing with cost of goods sold by combining what would come across on the worksheet for our parent and sub and impacted by our entries so that our total cost of goods sold is 352. The expenses here have no worksheet entries, so it's simply combining the two. So total consolidated profit is 113,000. Now we know from what we did in Chapter 3 this has to be allocated to the NCI and the controlling interest, and we do that, facilitate it with the income distribution schedules. The income distribution schedules start off with the internally generated income for each party, but then we have to take into account the impact of any worksheet entries that impact income. Now we're going to ignore the IS entry because it's an offset, direct offset, has no net income impact. So we're not going to put that in the IDS. This is the entry we need to focus on because there's a balance sheet and an income statement. Somebody's got to pick up that 12,000. The 12,000 adjustment belongs to the seller of the inventory. It could be either party, but it tells us in the problem in the text in this case it's the sub. So we're going to put it in the subs IDS, which changes then the NCI. You'll see if I take it back out for a second, NCI before was 11,000. With the adjustment, the NCI gets 86. So we're not properly distributing without that income distribution schedule, and which is why we use these IDSs. So again, just like we proved in Chapter 3, you see that total distribution of income is completed by splitting it between the NCI and the parent, and it's not just a strict 80-20 of this, or ownership percentage. It's based on the income distribution schedules. Now let's add to this by going to the next year, 2012, and we'll see that this ending inventory has to become the beginning inventory, because what we have on 12/31 is the same as what we have on 1/1. So now that cost of goods sold that we impacted, we're going to eliminate. We're just going to reverse it. So the cost of goods sold in essence acts as a temporary spot or a temporary adjustment to reflect that the inventory hasn't actually gone through cost of goods sold. It's because it's still sitting in inventory. In the subsequent year, though, there is no inventory left, because by the end of 2012, which is when we're doing the worksheet, that inventory would have been sold. So where inventory is sold flushes again through cost of goods sold, and that cost of goods sold ultimately is closed to retained earnings. It becomes a retained earnings adjustment in subsequent periods based on ownership percentage. In this case, ownership is 80% for parent, 20% for NCI. So that's how we allocate that. The IS entry is going to be identical to the prior year. Only thing different here is that the sales for the second year that happened internally were 110. So we fill that in for our IS entry. Our EI entry is done the same way. We want to know what was in ending inventory, which was 20,000 according to the text, and our profit factor again is what we want to eliminate, not the whole thing. So we're going to take 8,000 out of ending inventory. So the BI and the EI entries are impacted with gross profit. The IS is the full gross amount. Okay, again, this is a limited example, so we're going to just carry across like we would on a worksheet, combining the sales less the adjustment from the worksheet entry here for sales, our cost of goods sold starting columns, and also the adjusting entries. In this case, there's 3 adjusting entries that we have to consider. So we're going to take all of those into account so that our total cost of goods sold should be 426, giving us gross profit of 304. And then our expenses are just the combination because there was no worksheet entries. So the 123 is what we need to allocate. Again, we're going to use our IDS schedules as a tool for the allocation, starting with internally generated income for both the parent and the sub. You'll see the NCI before any adjustments would be getting 12.8. But that's not correct, because we can't just strictly take it based on ownership percentages. We need to adjust for these worksheet entries. Again, the IS entry we can ignore, but we are concerned about those 2 cost of goods sold amounts. Those adjustments go to the IDS of the seller. In this case, the sub is the seller. It could be either party, but in this case it's the sub. We put those in as debits and credits just like they are in the entry, just like you post in beginning financial accounting. And we now have reconciled our allocation, and you'll see the NCI now has a different allocation based on the profit that was earned from the prior income or sales, intercompany sales versus this year. So intercompany inventory is one of our primary intercompany events that we have to consider. We're going to incorporate this into the worksheet in the coming problems, but this should give you a good start.